This is InvestTalk. Independent thinking, shared success.
Hey, Justin and Luke, this is Andrew from Atlanta. Just trying to reach out to you guys about Lincoln Electric Holdings. It's down. I've held it for a while. Is this a good time to try to buy some more of it? Ticker symbol is LECO. Love the show. Thank you for your analysis.
All right, looking at Lincoln Electric. LECO is the symbol, and this is in machinery and tool space. It is an industrial name. It's been around for a long time. Let me pull up a long-term chart here. I love this going to like a quarterly chart. And this goes all the way back. This went public in 1995. So it's been around a long time. It's been on a long uptrend. And that's because its profitability is very strong, 35% return on equity. And historically, let me pull this up here, its profitability is hung closer to the high teens, low 20s. So it's probably a bit over earning, but still a great business. Very little debt on its balance sheet like that. Free cash flow of $534 million on about $11.6 billion enterprise value. It's a little less than a 5% free cash flow yield. Dividends 1.5%, but they continue to increase that dividend year after year. And they certainly have room to do that, to keep that going. And what are they doing with that cash flow? Well, they are buying back shares consistently. So these are the type of names I really like. Not exciting names, not huge growers, but consistent cash flows and strong businesses. This year, earnings are supposed to fall 2%, though, and then go up 10% next year to $9.97, $9.08 this year, $195 stock. So if you're looking at forward-looking earnings, it's about a 20 times multiple, which is on the it's a bit less than the overall market, and it's a great business. So, and for everyone else out there, what do they do? Like I said, it's in the industrial space, but they make welding, power sources, feeding systems for metal fabrication, construction, and other industries. So think machine tooling. I like this name. It has pulled back. It's very boring, but it is a leader in its space. It's based in Cleveland, Ohio, and it operates in 19 countries. So fairly well diversified. It has 11,000 employees worldwide. So even though its near-term chart is not that inspiring, let me pull that up here, I do think this is an interesting name over the long term. So I'm going to give Lincoln Electric a thumbs up. Thanks for the call. Let's go take a live call. Dan from Walnut Creek looking at Medtronics.
Hey, Justin.
Hey.
How you doing today?
Doing pretty well.
Good. I got a couple of questions with regards to Medtronic.
Mm-hmm.
About a year ago, you had mentioned that it was on your watch list, but it hasn't moved too much one way or the other since then. And even though it was on your watch list, I went ahead and purchased two small positions. And I had a question about if I was going to sell. If you purchase, if you have like a couple of positions, and you say, if an example, like if you purchased one and 11 months ago and one 13 months ago, and you sold them both in one lot, would the system figure out that you bought them, that one is a long term, one is a short term, or would it all be lumped into like a short term sell?
Yeah, the lots would be different. Yeah, one would be long-term, one would be short-term. Okay. You can also sell one and not the other. So you could talk to your broker and make sure that, right, either first in, first out, or last in, first out, et cetera, and figure out which one you really want to sell. Now, we do own Medtronic. Okay. We've owned it for a little while now. It's done, I think we bought it in the 70s. Now it's at 82 and change. It has pulled back. But what's important for us is it's actually outperforming its industry. So if I look at a chart and I put a ratio of Medtronics to like an IYH, it continues to do very well compared to the industry and its peers. And mainly because this is in the medical device field where, if you're talking about the pharma industry, they're having issues with drug pricing and the future of future pipeline due to reforms within the NIH, et cetera, and FDA. And then you also have the problems with the United Healths of the world and problems of Medicare Advantage, and they're getting lumped into that sector as well. So the medical device is the area that we've liked for a long time. And to us, it's been the most attractive for an investment from an investment standpoint. And I think we will continue to allocate there, including Medtronic. So it's a good business. Once again, not a fast grower, but it's a consistent business with good profitability and isn't subject to a lot of the issues that plague the rest of the healthcare space. So we're still a holder of Medtronics and had a really nice day today.
Okay, great. I have one more question to follow up on that
Sure.
one. So it's a PLC. Is there anything to be wary of if you're holding that in a brokerage account for like any tax implications?
Not that I know of. No, I think that shouldn't be an issue.
Okay.
Yep.
Okay, great. Thanks very much for your help. I appreciate it.
No problem. Thanks for the call.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos. Let's go talk to Dave in Fremont, and he wants to talk about investing in the country of Morocco. Dave,
yes. Hi. Really enjoy your show. Thanks for all you do.
Appreciate it.
Just a quick question. Yeah. I've heard that there are a lot of companies doing a lot of moving and growing companies in Morocco right now, and that Morocco could possibly be, like the big West Coast of America, how California has blossomed. A lot of stuff is growing right now and happening in Morocco. And I'm curious, what's a good way to get in and invest into a whole new country of growth, and how to get my money into something that would grow, maybe like an S&P of Morocco, or I really don't know anything about investing in foreign countries. So do you have any advice about that? Thank you.
Well, no problem. Thanks for the call. Now, that is a challenge because Morocco is such an emerging market, a very small country. And I've heard great things. It's actually on my list to go visit. And so I agree with that, to find ways to get exposure to countries like, or get exposure to Morocco. There's no real, I don't know of any ETF or anything like that. I'd have to dig in. There's probably some foreign companies that are listed on other exchanges that you might be able to purchase, and you can go do that through your broker, buy those foreign entities. But I don't know any off the top of my head. There's ETFs like the VanEck Africa ETF. I'm not seeing any exposure to Morocco though in this, because I can see in Morningstar what countries it's exposed to, but it's mainly South Africa. Actually, has some UK, Canada, Australia. Those are the main exposures. So, I don't see a direct exposure in trading on domestic markets. So I would have to just do a deep dive, and I've never done that for Morocco, but I would encourage you to do it. Thanks for the call. I love those questions, unique, because those are some of the plays that can be the most rewarding because there's not really money allocated there. If you're early on in that, and that becomes a common theme of investing in Morocco, and it's kind of in the Mediterranean on the north coast of Africa, it could be a great investment. But thanks for the insights. Let's play another caller question now.
Just want to get your thoughts on semiconductors, where you think we are as far as semiconductor stocks in the market, and what the best way is to play those here going forward. Do you like the SMH in general to get a good collection of those stocks, or do you have some favorite picks in the market? Thank you. Have a great day. Bye.
All right. Yeah. I mean, semiconductors, I typically like the picks and shovel type of companies that sell the equipment that do testing, things like that. The SMH, though, is a great ETF just to get broad exposure and that you're not betting too much on one particular company, although NVIDIA is 21% of this ETF, followed by Taiwan Semi. Broadcom is 9%. Those are the top 3. That does make up about 40% of this ETF. So I would want something that probably has a bit more diversity. So I think that this is a good place to start. We don't use ETFs. Let me see here. Let me look at some of the other semiconductor ETFs. Yeah, I don't see anything here. But that's a great, just broad exposure. It's an okay broad exposure, say that. I rather own the picks and shovels. I like the businesses that sell the equipment. So I would look for those names. I would take SMH. I would go look at the holdings to give your kind of opportunity set and do a deeper dive into all of them. Find which ones have the most consistent businesses. Here's the issue with semiconductors. They tend to be very boom or bust. They tend to make a lot of money in good times, and then they overcreate capacity. They overcreate end products and create oversupply within their system, and then they have to dump product, and their margins get hit, et cetera. That's the history of semiconductors. Now, certainly things have shifted with AI, and there's new kind of demand growth there. But I think history tells you that those within the space, they overextend themselves and they don't learn their lesson. Kind of like, I think it's similar to the oil industry, where everyone's just kind of chasing the next big thing. In that industry was shale, and there was just there's too much capital committed to areas that didn't have as much growth as they expected. It happens often in semiconductors as well. So the equipment manufacturers, I think, are better than the actual manufacturers and makers, or let's say designers of the end product, because that's what happens a lot of times. They're not actually producing the chips, right? Taiwan Semiconductor is, NVIDIA is just creating the architecture and the software behind it. Not to say that they're not good businesses. They are. They just tend to overextend themselves, and you get into down cycles. And I think we're closer to a down cycle than we are a new up cycle in semiconductors. So I'd be very careful within the space right now. Thanks for the call. Now let's go take another live call. Rico from New York, looking at APH.
How you doing, Justin?
Doing well. You're looking at Amphenol?
Amphenol, yeah. I've been looking through my watch list and currently trying to read up and trying to understand each business down the line. And Amphenol was next up on my list, and I was just wondering, is it worth getting into? I know Morningstar gives it's projected to have a significant growth over the next 5 years. And I just want to see how real this is, if the uncertainty with tariffs. I just wanted to hear your opinion on the company.
This is also on our watch list. It did kind of break out recently. It moved from a low after the tariff announcement to around 57. Now it's up to $89 roughly today. So a big move. It's overbought right now, but technically this is a breakout, and I would believe it. So I do like the business. It has it's a business that is needed, especially in times like this where they're building out the AI data centers, and Amphenol is really part of that. And certainly this is a clear indicator that I think the growth of AI data center deployment is still there, and the demand is still there. Revenues last quarter were up 48%, earnings were up 58%, earnings this year are supposed to be up 41%, and then 10% next year, but those estimates are being revised higher. So I like that trend. Now, if you look at roughly about $3 earnings next year, it's still trading at about a 30 times multiple, which is elevated, but it's probably justified. So while I think near term, it's probably a bit overbought, I probably would be picking up more on pullbacks.
And how deep would you say these pullbacks need to be? Because I typically don't want to pay for such. The valuation metrics are typically high, and I'm introducing a lot of risk as it goes higher. So I'm wondering how these pullbacks, 10%, 5%, how does KBP typically do it?
Well, when you get these breakouts, you typically get a retest of that breakout area. And that breakout area is around $80 per share. So we're at 89 now. If it pulls back in the low 80s, that's a good entry point for Amphenol.
Okay. Thank you so much.
Thank you for the call. Now let's touch on the travel industry and the problems that are arising there. Spending from foreign visitors to the U.S. is about to fall by about $8.5 billion this year. All tied to trade, negative perceptions around trade and immigration. This is from Oxford Economics. And that works out to about a 5% drop compared to last year. So mid-single digits, not catastrophe, but notable. International arrivals to the U.S. are expected to fall by 9%. Okay, so that's just travel in general. And the World Travel and Tourism Council said last month it expects the loss to be about $12.5 billion in spending. So depends on who you're talking to. It's going to be anywhere from the mid to high single digits in drop in spending. Flight bookings between the U.S. to the U.S. From foreign markets between May and July are down 11% year over year as of April. So remember, they're booking in April for May, June, and July, down 11%. Now, the biggest laggards, notably Canada and Europe. So Europe's down about 10% year over year. Canada, though, down 33%. That's where most of the drop in tourism is coming from. Now, the U.S. Travel Association projects the U.S. will lose $21 billion in travel-related revenue this year. And for every 1% drop in spending from international visitors, that translates to $1.8 billion in lost revenue to the broader U.S. economy. So this is, this could just be a flash in the pan. It could just be, hey, they're annoyed. They don't want to spend their money on the United States right now. And, especially with the Trump administration it could be more of a 4-year thing, maybe returns to normal at some point after his administration. But I do think this is going to be a modest drag on the industry as a whole. Now, part of the reason, too, is a stronger dollar. Now, that is ameliorating a little bit because the dollar is down so far this year pretty considerably. And so over time, if the dollar continues to fall, that will kind of solve some of these issues. But I do think that you have to look at the next 4 years as a rougher time for the travel industry here in the United States. So if you're looking at hotel stocks or travel websites, things like that, it has to be relatively cheap in order to really get excited about investing in those stocks. So I wanted to highlight that because you really have to look at kind of the broader trends so you really understand what tailwinds or headwinds you might have from a particular sector. Now let's go take a question that came in via our YouTube channel. And Luke says, hello, I would like to know what you guys think of OKE after a rough earnings. And this recent sell-off that followed, are you still holding for your clients, adding to your position, or selling? We are currently holding. It's been a big winner for us over many years. Now, the the momentum has waned, especially if you look on a weekly chart. It's pulled back to the 100-week moving average. And I do think that there are some headwinds. We're still holding. I could see us trimming, though, in the near term because of that weaker momentum. It does still have a great business. It pays a nice solid dividend. Current yield is 5.1%. And earnings are expected to go up 4% this year, 11% next year. For everyone else out there, this is a company that basically moves natural gas and natural gas liquids, and it collects a toll for moving those products within their system especially from the site of the drilling I think shale, into markets where it can be distributed and used. And that is a great business. $50 billion market cap and very strong free cash flow. Last quarter revenues are up 68%. So overall, I still like it, but it's more of a hold right now than add to it. Now let's squeeze in another listener question.
I just wanted to get you guys' opinion on the stock. I'm looking at Carter's Children's and Baby Clothes Company. I just wanted to know the long-term outlook on it, and what would be a good price to get in and hold for, maybe 5 years or so. Thanks. I appreciate you guys helping. I'll keep listening to the show. Thanks.
All right. Looking at Carter's, CRI is a symbol, $1.2 billion market cap. Problem is earnings are in decline, down 42% this year, 22% next year. And to me, it's not a name that I would buy. You're probably looking at that yield, 8.2%. I think that yield is going to be cut. That's what the market is telling you. And you see that with the decline in earnings. Although earnings estimates are headed a bit higher, the broader issue is that the birth rate in the United States is very low. And it's not really improving. Mainly because cost of living, cost of raising a child is prohibitive. And I think that's why Carter's is struggling. So it's not a name that I would get excited about jumping in on. And you're probably chasing that yield. And it's very important when you're looking at these type of companies that are in a strong downtrend, that have high dividend yield, that you need to dig a little deeper and you need to ask yourself, is the market telling you something? And the answer is probably yes. And that's why I would pass on Carter's. CRI is the symbol, and it is relative strength is 9. And yeah, I think let me pull up its payout ratio. Current payout ratio is, where are we? 71%. And earnings are declining more. So that dividend, actually, it already cut it. I lied. That's going backwards. So it already cut it from 80 cents to 25 cents. And so you might be looking at the 8% yield. That's backwards looking. It's not paying that now. It's back to 2%. And I would still not buy the stock. Discover more valuable information at investtalk.com.
I'm calling today about KB Home, ticker symbol KBH. I know you guys used to own some home builders, so I was just wondering how you feel about the sector right now, and specifically KB Homes. Just wondering what you think about the company. Thank you. Bye.
All right, looking at KB Homes, KBH is the symbol, and they're struggling along with a lot of the home builders because the demand for homes is just down. Even if you buy down rates, it used to be, hey, rates are at 6, they can buy them down to 5, maybe 4.5. Their margins are relatively high, so that's no big deal. It cuts into their margins, but their margins go from being high to kind of average, and they're still in a good place. That in some ways is still the case, but in other ways it's not, because now rates are closer to 7. Even at a 6% mortgage rate at current prices, it doesn't pencil out as much as it used to. The cost for inputs and labor are continuing to go up, and their margins, KB Homes margins peaked out. Operating margins peaked out at 15.3 back in, when was this? 2022, and now it's at 11. Okay, so once again, that's closer to longer term averages. So that's not terrible. And they're still earning money, but the growth of sales is certainly slowing. You saw that with existing home sales report today. Last quarter revenues were down 5%, earnings were down 15%, and overall earnings are expected to fall 17% this year, and those estimates are coming down. Relative strength of KB Homes is only 13, so as you would imagine, that chart is not very hot either. So it's a name that I would continue to watch. I do think if you get a drop in mortgage rates, you could get a resurgence in demand. But the labor market weakening, rates remaining high, I think these home builders will continue to struggle for at least the next few months. And so I'm passing on the home builders. We did the big run up in 2022, 23. We did own, I think, one or two home builders, and we did very well on them. We sold them, I think, in early last year, and then went up a little bit more, but rolled over late last year and really haven't recovered. And so I would continue to be patient on these home builders. I just think that the earnings picture going forward remains a bit murky. You also are seeing elevated levels of inventory on the new home market. And so they're gonna have to work through that, and how many price cuts are they going to need to take in order to get those moved is a big question mark as well. So while I don't think that there's things that you keep off your watch list, I think there's definitely a lot of home builders, including KB Homes, that has nice tailwinds over the longer term. I think the near term headwinds are just too much. Now, would KB Homes be at the top of my list? No, it's more closer to the middle than the top. Let's say that. I think there are much better ones out there. A lot of them are smaller. Some of them are bigger. It all depends on kind of the geographic makeup of the markets they operate in, the balance sheet, and the type of homes they build as well. So while KB Homes isn't bad, it's once again it's just not the one I would pick as my horse if I was going to invest in the home building industry. But thanks for the call. Love the question, and keep on bringing them. Well, that about does it. Thank you for tuning in to this latest episode of InvestTalk. A reminder that you can find our free podcast anytime at iTunes, Spotify, Google Play, and encourage you to tell your friends and family members about them as well. And if today's show made you think about your own financial picture, investments, taxes, retirement, and whether it's all really working in this environment, let's talk about it. At KPP Financial, we offer a no-cost portfolio review to help bring clarity and confidence to your broad financial picture, as well as your portfolio. So just head over to investtalk.com, click on the portfolio review button, fill that out, and we will set something up. Independent thinking, shared success. This is InvestTalk. Good night.